I see at least 140,000 actually in this next move we're going to see. I think it's going to come pretty soon, and then I think you're going to see somewhat of a pullback. But I think it probably going to find a top somewhere around 165 to 170,000, maybe 175,000 in that area. And that's not again too far out. We're talking about something that can happen really quick into the final phase of things. So I just want to caution people on this, that the Bitcoin is just going to go up and up. It's not. It is a risk asset, and it's a very volatile risk asset. Yeah, I think Ethereum actually has such a long way to go still, and I got a target around 17,000 on that, and not in a straight line, but it's just the ratio to what we see with Bitcoin.
What happens when the Fed's playbook stops working, the dollar roars higher, and crypto faces its biggest test yet? As the Fed's tools lose power, Bitcoin and Ethereum are emerging as the new anchors in an inflation-driven world. Henrik Zeberg, head economist at Swissblock, warns that while the Federal Reserve still carries weight with its balance sheet and bazookas, its tools are increasingly limited in an inflationary regime. Traditionally, the Fed relied on lowering rates, open market operations, or acting as lender of last resort to inject liquidity during crises. For decades, this strategy appeared to work, as the post-1981 deflationary trend kept yields and inflation moving lower regardless of stimulus. But COVID-19 marked a turning point. Supply chain breakdowns, combined with unprecedented fiscal and monetary injections, ignited inflation the Fed underestimated. With inflation peaking at 9% and 10-year yield momentum shifting for only the fourth time since the 1920s, Zeberg argues we have entered a new regime. In this environment, stimulus risks fueling inflation rather than stabilizing growth. The Fed's old playbook, creating a wealth effect through asset price gains, may no longer deliver the same results. Meanwhile, markets are adapting. As of September 5, 2025, Ethereum trades at $4,407 and Bitcoin at $112,167, both advancing steadily. Their resilience underscores how digital assets are increasingly viewed as hedges in a world where traditional monetary policy looks increasingly impotent. This is just the first step in understanding crypto's journey. The real story is only beginning to unfold. Stay tuned, hit like, subscribe, and ring the bell so you never miss the next big shift in Bitcoin, Ethereum, and the future of global finance.
The Fed will try to do something, but the only thing they can do is try to loosen financial conditions and support with liquidity. And the thing is, we've gotten used to that liquidity can solve everything for the last many years, and every time we had a problem, we just poured some more liquidity on it. Then things were fine for a period. But the problem is that has changed. That is actually the one thing that is different this time around, which is that we've seen a seismic shift in the inflation regime. So since 1981, we have had a deflationary regime, which means that yields were going down. No matter what we try to do, we could throw money out the window, and yields were just still going lower. Inflation was going lower. And then we had the COVID situation, and the central banks came out and they stimulated the shit out of things with just to get things started, they thought. But again, it was actually a supply crisis. A lot of people had to go home because they couldn't go to where they worked, and which means that the supply chains actually started to break down. And then you give everybody a paycheck, an extra fiscal stimulus, and you lower the interest rates, and everybody had a lot of money in their hands. So what do you do when you get a lot of money in your hands? You spend it into a supply chain crisis. I mean, supply and demand, supply is diminishing and demand is rising. What do you get? Inflation. And all of a sudden, and the Fed were not really on top of that because they did not expect inflation to go up to 9%, I can promise you. And then they all of a sudden, now we need to be all hawkish on things. And then they start to be very hawkish on things, and they are now again into the very big policy mistake here. So things are as they normally are. And I think we will have some more time. They will try to do this again. The problem is just that, and that's the point actually of what I was talking to here, is that this time around, they actually managed to bring inflation out. And if you look at it in a very long-term time scale here, you can actually see that there is a shift in the 10-year yields in terms of momentum. It's something that's a chart I brought up quite often. And if you look at that on a 3-month basis, you can see that shift has only happened 4 times since 1920s. We have a shift now, which is remarkable. Doesn't mean inflation will go up from here, because inflation always goes in a trend, but ups and downs, and it goes down in a trend like ups and downs. But the shift is to now that we have a change in the regime coming from a deflationary downward pressure on inflation and yields to an upward pressure. And what happens then, if the Fed comes out one more time and pumps money into the system, is that they will get what our parents and grandparents that knew that if you pump inflation, yes, I mean that's when the 60s and the 60s and the 70s they knew that. I mean, if you pump money into the system, you're going to get inflation. But we've just been taught that inflation is something we are now on top of. Guess what? It's here again. It's the ghost. The genie is out. It's so clear it's out. That's all. Jeff Gondlach also said that, well, now he's starting to short bonds. I think it's a little early. Let's be clear on that, because I don't think yields will go straight up from here. Actually, on the contrary, I think they're going to decline first. But you are seeing a new inflationary regime. And that is the problem. And that means that the tools of the Fed will become impotent. They won't be able to just use it. They won't be able to try to stimulate and get the trickle-down effect. So there will be, and that's the problem for the Fed, because for quite some time they've been able to at least somehow create a trickle-down effect. So what do I mean about that? If they lower yields, they'll see that more money will flow into the markets, and then you'll see that the asset prices are moving up, and people feel more wealthy, and they'll start to spend money, and they can get all of that.
As the dollar shows signs of roaring back, Henrik Zeberg warns that its strength could be the wrecking ball for crypto, stocks, and risk assets worldwide. Henrik Zeberg cautions that the US dollar could be the trigger for a broad downturn across risk assets, including cryptocurrencies. He expects the dollar index, DXY, to rise toward 117 to 120, a move that would pressure markets worldwide. Drawing parallels with past bubbles, such as Tulip Mania, the South Sea bubble, and the dot-com crash, Zeberg warns that today's crypto surge carries similar speculative traits fueled by years of easy money and liquidity. Although crypto has established itself over the past decade, Zeberg believes only a handful of projects will survive long-term. Just as Amazon and Google emerged from the wreckage of the dot-com era, a few tokens may endure, but he warns that 99% could collapse or disappear entirely. Even strong projects, he notes, are vulnerable in a broader market downturn. For investors, the message is clear: avoid blind speculation and focus on projects with real utility, credible teams, and active communities. Diversification, across crypto and traditional assets, remains critical. In an environment where the dollar strengthens and bubbles deflate, disciplined strategies may be the only safeguard against severe losses. Let's get back to the interview.
I see at least 140,000 in this next move we're going to see. I think it's going to come pretty soon. And then I think you're going to see somewhat of a pullback, but I think it probably going to find a top somewhere around 165 to 170,000, maybe 175,000 in that area. And that's not, again, too far out. We're talking about something that can happen really quick into the final phase of things. So I just want to caution people on this, that the Bitcoin is just going to go up and up. It's not. No. It is a risk asset, and it's a very volatile risk asset. Yeah, I think Ethereum actually has such a long way to go still, and I got a target around 17,000 on that, and not in a straight line, but it's just the ratio to what we see with Bitcoin. You will normally see also, especially when the alts phase or the Ethereum phase we're in now, that the ratio will improve quite a lot, and there is a level that says that we can get to around 0.1, 0.12 ish on the on that Ethereum ratio, and that means that Ethereum should go to around 17,000. So I think we have, as I said, we have quite some distance to cover still before we get to the top. But that's not the same as it's going to last for a year, because we have to understand that when things are moving in crypto and into the final phase of a bubble, it can be very, very fast. And it's really about watching for one thing, and that's the dollar. The dollar is the one thing that I'm keeping an eye on in terms of when that makes it bottom. I think it's about time to find the exit door. So I think it's going to be the dollar that brings down crypto, that brings down, and stock markets. Again, it'll be about the dollar. Everything is about the dollar, and the dollar is going to bottom out, and I think we're going to see a top in that, which will go all the way to around 117, 120 on the Dixie. So it's quite a distance we got to cover there. And if I'm right on that, everything is going to be crushed. And I think, unfortunately, I mean, we have had bubbles so many times before in history. We have had the South Sea bubble. We have had the tulip crisis, also the tulip bubble. We have had the railway bubble. We have had the bubble in 1920s, the 2000 bubble, and so on and so forth. We have had so many bubbles. And the thing is simply that when it bursts, you're going to see that a lot of people will have been dragged into it because of crowd dynamics, because of, oh, this time is different, this is now the new shit, and you got to be in it. Unfortunately, this time we have seen a lot of support for crypto, and it's been around for quite long because of the easy money policies. So it has had around 10 years of runtime here, and people start to believe, oh, this is now so it's part of the financial system now. I don't think it is. I think there's going to be, out of the thousands and thousands of crypto projects you have, that you're going to see that that it's only going to be a very few of those that are going to make it and become the next Amazon or the next whatever. It's going to be Google or something like that. But even those back in the days were also crushed into a phase where everything was declining. So I think you will have a few of the crypto projects, but it's not going to be as cryptocurrencies. So back to your question. Yes, I think a lot of investors now are actually piling on something which they don't really understand, and that they buy at ridiculously high prices because nobody understands which one is really the big one that you should hold on to. And 99% of them is going to crash and evaporate, maybe also disappear. So I think a lot of people can actually lose a lot of money. And if that's the case, and then in Holland, I fear it's the same in a lot of places around the world, maybe even more so in the US, where we also seen the US administration trying to push people into crypto on their retirement funds, which I think is lunacy, honestly. So I think we're going to see this having widespread problems into a lot of homes and families getting really hit hard by this. And I can only send out a warning here and saying I think people need to think this is a bubble, just like what they said. That's why I tried to mention the different bubbles here we've seen over time, and we will see it come crashing down. And you're going to lose money if you are not if you don't find a way to stay on the sidelines for some time at least, because of course there can be some good projects in the longer run, but it's not going to be all of them.
The dollar's resurgence, rising inflationary pressures, and fading effectiveness of Fed policy signal a new and more volatile market era. Crypto may have proven its staying power, but history shows that only a select few assets will truly endure while the majority risk collapse. For investors, the path forward demands caution, avoid chasing hype, focus on projects with real utility, and diversify across both digital and traditional markets. In a world where bubbles deflate and currencies drive direction, disciplined strategies will separate those who preserve wealth from those who get caught in the crash. If the dollar surges and the bubble bursts, will Bitcoin and Ethereum stand as true hedges, or will they fall with the rest of the market? Crypto may be the future, but survival depends on discipline. Don't chase hype, focus on fundamentals. Thanks for watching, and don't forget to like, share, and subscribe for more insights.